That's it. No.
Okay. Let me share my screen again. Okay. Okay, cool. So this is chapter 3. In chapter 3, we have investment banking. And we look at the role of investment banks, price and volatility of initial public offerings, the definition of shelf registrations, and some regulations and Sarbanes-Oxley Act of 2002. So this is just recap. What is the meaning of the annual percentage rate and effective annual rate? And as you see, okay, okay, I just want to, okay, see the chat. Okay, as you see, now we have quarterly compound. And the previous example, we have monthly compound. If it is monthly, you just choose M12. If it is quarterly, you choose M4. I think we should solve this question from the top. Let's read the question. How can we convert between annual percentage rate and effective annual rate? So interest rate per compounding period is equals to APR over M. M is the number of compounding period per year. So this is the formula that we are using in the question. Let's look at the question. A credit card charges 27% annual percentage rate and compound quarterly. What is the effective annual rate? So the question just simply asks, what is the compounding rate? And what is given? The question says it's compounding quarterly, meaning that it compounds every quarter, and the number of periods, as you see, number of compounding periods per year is 4. So we choose M4. Just put the M in the equation. We have 4 here. 27% is the APR. 1 plus 27 or 4, power of 4 is equals to effective annual rate plus 1. So we just simply find the effective annual rate, 29.86%. You can do it manually, just solve this question manually, but you should learn how to use a financial calculator. I hope, or I assume that you already have financial calculator and know how to use these calculations, because now it's simple. The calculation is very simple, but when we go to other chapters like chapter 4 or other chapters, you will see we have more complex calculations. Okay, there's a question, where can we find one? If we don't, you can order one. I give the which calculators you need. The first one is Texas Instruments. You can just go to syllabus, and you should find the name of the calculator and the specifications of the calculator. So yeah, it's simply, you can buy it or you can borrow from, I guess, the library, GPL library. Anyway. Okay, this is a big picture. I always show this picture to you. I mean, you will just you will see this figure many times, and this is just the summary of finance. Okay, like we have savers, we have borrowers, and we have financial intermediaries, we have financial market participants, and there's some relationships between those guys, right? So every chapter we just visit some of them. We already visit the indirect transfer, direct transfer, and we explain financial intermediaries, and we talk about primary markets, secondary market. But every chapter we just visit this players in diamond graph. This is the definition from the book. It looks like a diamond. That's why the book gives the name. Anyway, so the role of investment banks. Okay, we need to know the definition of the investment banker, which is the middleman that brings together investors and borrowers. It could be firms or government. So and the investment banker issuing new securities. So think about this in this. Think about this scenario. So you own a firm, and you want to go IPO. In other words, initial public offering. What does it mean? You want to sell your shares in public, and the first thing you need to do is you just go find an investment banker. Could be a Bank of America, Merrill Lynch, or other investment banker, and they they issue the securities, and you and they also promote or market the sale, and so basically investment banker is the middleman that brings the investors, which the people they want to buy your share, the firm share, and the firm and the firm, and they issue the new securities. An IPO is the initial public offering, which is the process of selling shares to the public, and the definition is first sale of common stock to the general public. Underwriting is the investment banker buys the stocks to sell them, and the firm committed granted investment bankers bears risk. So in other words, they underwrite the stocks. So they buy the stocks that firms want to sell, and they sell the stocks on behalf of the firm. This is a process of intermediation, and you want to sell your stocks. You own a company, it's getting bigger and bigger. You want to finance, you need some funds. Okay, you decided to go public. The first thing, you need to go find an investment banker. It could be any financial firm like Bank of America, Merrill Lynch, other big guys, or small intermediaries, and then they underwrite. They have underwriting services, which means they buy the stocks and then they sell them to the in the IPO, initial public offering process. And they have best offers agreements, so they don't give any guarantee, but they try to sell all stocks to the public, to the investors, and the firm bears all the risk. So it could be a failure, like there are plenty of failures of selling stocks in the initial public offering. If you're interested in finance or in investing in stock markets, you probably know many failures of initial public offerings. If no one wants to buy that specific company stock, that's a failure. They don't guarantee that they can sell all of them. They can sell all the stocks. Anyway, originating house is, just think about, you want to sell your stock and you need to find investment banker, let's say Bank of America, right? Merrill Lynch, Bank of America, Merrill Lynch or Bank of America. And but you don't, but it's a very big IPO. You're selling 100 million shares, each worth $10. It's a huge IPO, such as Facebook or Apple or Microsoft IPO, like big IPOs. For big IPOs, it's not enough to have one investment bank, because you want to sell it in Dubai, in Hong Kong, in England, all around the world, and it's a huge IPO. So just one bank is not enough. What you can do? You just you can choose multiple investment bankers, Bank of America, Merrill Lynch, other financial institutions, and they get together and they form a syndicate, meaning they just forming syndicates. They collaboratively work on the IPO. So the originating house is the investment banker who is responsible to form the syndicate. In other words, okay, you're saying, Merrill Lynch, you are the originating house, you are the leader of this team, and you form the syndicate, and you find the channels, the best channel that we sell our stocks to the stock market, and the originating house, in this case maybe Merrill Lynch, form a syndicate because the Merrill Lynch knows Merrill Lynch experience in many IPOs. They know the best channel to promote or market the stock, and they form a syndicate. So the originating house is the investment banker who forms the syndicate. Preliminary prospectus. Prospectus is, okay, first, the starting point for the initial public offering is the board of directors decided to go public, and then they prepare a prospectus, which is just an explanation of the mission of the company, the prospectus, the projection of the company, and the financial performance of the company. Let's say balance sheet, income statement, cash flow statement, and other statements, and they just show the health of the company. They just inform the public. So it's a kind of booklet. They call it prospectus, and they just prepare it. This is just the initial draft, and they submit this preliminary prospectus to the initial public offering. To investment banker, and also SEC, which is the Securities Exchange Commission, the regulatory body who is responsible to approve the prospectus based on the information given by the company. They try to, they have a checklist. They just look at the requirements of the prospectus. If the company satisfy all the checklists, for example, last 3 years balance sheets, last 3 years cash flow statements, they just checklist, and they approve the prospectus, and then now they have approved prospectus. Anyway, I give just an IPO example, Alibaba, and you can read it. I just I talk about preliminary prospectus and registration with the Securities Exchange Commission, and then roadshow for investors. Who does roadshow? So if you go back to initial example, you want to go to public. It's a huge IPO, and you need to promote your company. You need to attract investors. So roadshow is kind of information sessions for the institutional investors, and the investment banker, let's say Merrill Lynch, just promote and market the company and the IPO, and they manage a roadshow. In that roadshow, they meet the investors, they explain the prospectus, how potential that the company has, the industry, the company itself. Think about Uber or Lyft IPOs. They just explain the Uber potential, the possible customer acquisitions, and blah blah. So they just try to market the IPO. Who does that? Investor bankers. Let's say Merrill Lynch, on behalf of the firm. Okay, just an example of Facebook IPO. At that time, they sell 70 million shares, and they explain the risk factors. You see, in JP Morgan, Bank of America, Merrill Lynch, Morgan Stanley, Barclays, all the other investment bankers, and it's not only one. They don't just go Merrill Lynch or Morgan. So this is syndicate, example of syndicate. All these guys get together and try to sell the Facebook shares. Okay, we only have 7. Okay, Austin. I don't know, maybe I just restrict to just jump in the meeting. So that's why people just um, require admission from me. Which is not good. Yeah, I need to fix this. Sorry about that, Austin. Okay. Oh, maybe I should take this here. Okay. Yeah. Any questions? Yeah. Rich, you're right. It's a big party, you know? So they need to gain customers. You're exactly right. So you're selling your company and you need to attract customers. Even you not only US customers, you want to attract the Middle East, Chinese customers or other customers all around the world. So they don't know your company. You're just a small or big company in US doing business in Texas, and who knows you? So they need to promote. They need to market your company on behalf of you. Anyway, it's a very interesting topic, and I love to talk it like 1 hour. I can talk it, you know. Anyway, volatility of the market. I'm pretty sure you all know the volatility of the market. What is the meaning of volatility? Volatility is just is the standard deviation of the price levels, and you can easily see from this figure. If you look at this chart, the Uber and Lyft, you see the gray line is the Uber price, stock price after the IPO. They did very bad, to be honest. We can talk it later, like Uber and Lyft appraisal, the stock appraisal. They after the IPO, they performed very bad. You see, this is the time they went to IPO. Let's look at Lyft. Everyone knows Lyft, right? So the stock price just fell down and get some rise and then down again. I don't know the recent price level. I need to check it, but this is not a good IPO, because basically, if you're investing a company, you're expecting to buy stock in low levels. Like, let's say, I remember the Lyft stock price maybe 40 or 40 something per share. You're expecting buying stock from Lyft like $40 per share. You're expecting 6 months or 1 year, at least some amount of appraisal, right? But as you see, after the IPO, Lyft lose almost 40% its value. Anyway, okay, this is the Snap, Incorporation stock performance. As you see, price can rise and decline dramatically. Few IPOs are really successful. Blah blah. Yeah. So hot IPO means in the IPO market, if the stock price is increase after the IPO, we call it hot IPO market. This is not a hot IPO market. As you see, we have a steep decline after the IPO. Any question? Any questions? Another example for Twitter and Facebook. As you see, Twitter, after the IPO, Twitter performed very well. You see, this is the time that they went to IPO, and this is for Twitter, and this dark blue line for the Facebook. As you see, they lose some value. Anyway, I give too much example. Okay, for the only thing I want to mention here is that for the emerging market, the first day IPO return is higher than the developed markets. Like for between 1971 and 2006, when we look at the Canada IPOs between this period, this is the first day IPO return, which is, I guess, maybe 10 or 15%. But if you go to China or India or Brazil, this is the first day return, which is crazy. You see, China almost 165. It shows the volatility, actually, the intraday volatility. Anyway, okay, just speed up because we have only 13 minutes to finish this session. Again, volatility. Okay, another concept you need to know is self-registration, which is information filed with the SEC, Securities Exchange Commission, for seasoned equity offerings. Firms return to equity markets and offer new shares for sale. It gives flexibility. Securities sold as funds are needed. So, okay, simply we can explain self-registration is company want to sell its stocks to the public, and they need to register the stocks. And when you go back to, if you go back to Facebook example, you remember they sell 70 million shares. So when Facebook want to share 70 million shares, first they need to register these shares in order to sell these shares to the public. So they go to investment banks like JP Morgan, and then they apply Securities Exchange Commission to register the shares and approve their preliminary prospectus. And then Facebook can decide, Mark Zuckerberg can say, okay, I want to only sell like 50 million of shares now, and I may sell 20 million shares in 6 months. They don't need to sell all of them at the same time, which gives corporations the flexibility in the sense that maybe they think maybe they think, okay, if I just sell 50 million shares of Facebook and people realize they gain some money by investing Facebook stocks, he can decide to increase the value of the stocks, and maybe he can sell a higher level of stock price. So this is we call it shelf registration. So it gives flexibility to the firms. Yes, private placement, another concept. This is non-public sales of stocks or bonds. So there's no public sale, and venture capital firms, venture capital investors or mutual funds can buy these shares from the company. So this is not IPO, this is just private placement. They're directly selling the shares or stocks to venture capital or mutual funds. Again, this is direct sale, reduce the selling costs, and because there's no stock exchange in these transactions, and features can be tailor-made for both parties, and we call it PIPEs. This transaction called PIPE, meaning private investment in public equities. In other words, okay, this is different. PIPE is, I don't want to give you too much information. Just know there's a private placement and also a private placement in public equities. Private placement is companies, non-public firms, private firms can sell their shares privately, not having initial public offering. They just they attract some venture capital investors. Did you see Shark Tank? You probably saw the series, right? So if they attract the Shark Tank, they can invest the company. They don't want to go JP Morgan. They don't need to pay fees to those big guys in Wall Street sharks. Instead of going Wall Street sharks, they may go to Shark Tank, and they can just attract those guys. We call them angel investors, and also they may be venture capitalists. Anyway, so in order to reduce the cost of intermediary, they can go privately and sell their shares to venture capitalists, which is called private placement. another branch of private placement, PIPEs. Now, in that case, you already a public company, let's say Facebook. Facebook can sell shares privately, like sell the shares through some of them or all of them to a private company. So if the Facebook sell, let's say Google want to buy Facebook, right? And no, it's not the correct example. Some company should be private. Think about a private company. Then I don't know. CPS Energy wants to buy Facebook. Okay, so if CPS Energy has that money, which is ridiculous, but in that hypothetical example, they want to buy Facebook, public company. So private company buys public company stocks. If they own all the private public stocks, so Facebook no longer be a public company, it returns to a private company. Anyway, if it just confuse you, don't bother, just very detailed information. No one asks you pipes, okay? Just extra information. Okay, the last part, regulations. So the Securities Exchange Commission requires a full disclosure, and this is very important to give the full disclosure of the company to the public, to the investors. So how they do that? As the Securities Exchange Commission require 10K and 10Q reports. 10K is the yearly report, yearly balance sheet, cash flow statement, and all other financial statements. 10Q is the quarterly reports. Also, the regulations try to stop the illegal use of information, insider information. This is a huge topic. If you are interested in, I can suggest you many sources about insider trading. There are many series, many investigations regarding insider trading. What is insider trading? Do you have an idea? Insider trading is you're the boss, and you know the company better than anyone else, and you know all the private information regarding your company, and you can buy or sell your stocks based on your insider information, and you can make money, a lot of money. So this is illegal. You cannot use inside information, private information, because this is you're cheating. You're just using non-public information on behalf of your financials. So it's illegal. SEC, as I told before, Securities Exchange Commission is a responsible regulatory body for IPO and capital market regulations. Information disclosure they require information disclosure at new issues, new bond or stock issues. Any information needs to be published that may materially affect the value of securities. So we also have Securities Investor Protection Corporation, which insures accounts against failure by brokerage firms. So they cover at most 500 grand per customer. And Sarbanes-Oxley 2002, this regulation is issued after the huge fraud from Enron. Maybe you may remember, or you heard of the Enron scandal. And after this scandal, I guess 2001 or 2000, and they introduced this regulation, and it's created in response to economic fraud and securities analysis touting of stocks. So it enforced public companies' increased disclosure and firewall between investment bankers and security analysts. The timeline of this regulation and the basics of compliance. It requires keep data secure and free of tampering, track attempt security breaches and resolutions, keep event logs available for independent auditing, prove compliance for past 90 days. Okay, you can read this scandal. It's very interesting. There's some Netflix series about this. I heard, or I just saw, and it's very interesting. They Houston-based Community and Energy Service Corporation. They are just simply what they did. They just kept the huge debts off the balance sheet. They show they don't have that. They only have huge assets and cash, all the stuff, but they don't show their debts. They show the debts in another account. No one knows how huge debts they have. So they conduct crime. Okay, so we covered chapter 1, 2, and 3. I think we can finish this session. If you don't have any questions, you can send an email after the session. Don't forget to take the quiz 1 today, and I think you will have access at 2 p.m. And I'll give you almost 8 hours to access the quiz 1, but you only have 1 hour to complete the test. It's just 10 questions. I think it's super easy. And if you have any questions, I can answer right now, or you can just email me. I think that's all for today. Thank you for your attention. See you next time.